June 23, 2003, the day a gun was reportedly pointed at senior accountants in Birmingham, Alabama, would become the chilling catalyst that exposed one of the largest corporate frauds in American healthcare history. The man at the center of the storm, Richard "Rick" Scrushy, then CEO of HealthSouth Corp., forced his chief financial officers to rewrite earnings reports under the threat of violence, setting in motion a deceit that would inflate the company's net income by more than $2.7 billion over 5 years. HealthSouth began in 1984 as a modest chain of physical therapy clinics founded by a young surgeon named Richard Scrushy. By the late 1990s, the company had morphed into a sprawling conglomerate of hospitals, surgery centers, and outpatient facilities, proudly touting itself as the nation's fastest-growing health care provider. Its aggressive expansion was fueled by a relentless pursuit of Wall Street's approval. Analysts demanded ever higher quarterly earnings, and Scrubby's charismatic leadership promised growth that seemed almost superhuman. Behind the glossy press releases, a culture of intimidation took root. Scrushy demanded that the company's financial statements always meet or exceed analyst expectations, regardless of the underlying reality. When the numbers fell short, he allegedly summoned the CFOs to private meetings, brandishing a handgun and demanding that they make the numbers work. The threat was not metaphorical. Several senior accountants later testified that they heard the unmistakable click of a loaded pistol as they were ordered to fabricate revenue, inflate assets, and understate expenses. From 1998 to 2002, the fraud unfolded through a complex web of false journal entries, fictitious patient admissions, and bogus vendor invoices. Internal auditors discovered that more than $1 billion in cash balances never existed, while assets such as property and equipment were grossly overstated. The company's stock, which had surged past $50 per share in early 2002, began to wobble as the true financial picture emerged. In March 2003, a whistleblower, a senior accountant named Thomas "Tom" Hall, approached the Securities and Exchange Commission (SEC) with evidence of the manipulation, prompting a federal investigation that would soon rock the healthcare industry. The SEC's civil complaint, filed in June 2003, alleged that HealthSouth had engaged in a systematic scheme to inflate earnings and hide losses, violating the Securities Exchange Act of 1934. The investigation uncovered over 5,000 fraudulent entries, each designed to portray a healthier bottom line than reality allowed. The company's auditors, KPMG, faced intense scrutiny for failing to detect the deception, leading to a $115 million settlement with the SEC for alleged audit deficiencies. The criminal case against Scrubby and several top executives began in earnest in 2004, when a federal grand jury in the Northern District of Alabama returned an indictment charging Scrubby with 37 counts of conspiracy, fraud, and making false statements to regulators. The courtroom drama unfolded like a thriller. Prosecutors painted a portrait of a CEO who wielded his pistol as a tool of corporate governance, while the defense argued that Scrubby was a charismatic leader who had merely encouraged aggressive accounting within the bounds of legal practice. Key witnesses included former CFOs who recounted the midnight meetings in Scrubby's office, the cold steel of a pistol on the table, and the frantic typing of entries that turned red ink into green profit. One CFO, James "Jim" Miller, testified that he felt his life was in danger, describing how Scrubby's voice trembled with rage when the numbers missed the target, and how the gun's barrel was pointed directly at his head as he was ordered to fix the statements. The prosecution presented emails, internal memos, and a recorded conversation where Scrubby explicitly demanded a profit number that looks good to the analysts, followed by a threat that, if you don't do it, you'll be the one who gets the blame. After a grueling 6-month trial, the jury returned a verdict on February 6, 2005. Richard Scrubby was found guilty on 36 counts, including conspiracy to commit securities fraud and false statements. He was sentenced to 8 years in federal prison, ordered to pay $2.8 billion in restitution, and barred for life from serving as an officer or director of any public company. 2 other executives, former CFOs Robert Bob Bick and Thomas Tom Hall, received sentences of 5 and 3 years respectively, each also mandated to forfeit millions in bonuses earned during the fraud period. The aftermath rippled far beyond the courtroom. HealthSouth stock plummeted from its $50 plus peak to under $5, erasing billions in shareholder value. The company entered Chapter 11 bankruptcy protection in 2003, restructured, and eventually emerged as a leaner entity, rebranding as Encompass Health Corporation. The scandal prompted sweeping reforms in healthcare accounting, including tighter SEC oversight, mandatory internal controls, and the adoption of more rigorous audit standards for hospitals and health service providers. In the broader corporate world, the HealthSouth case became a cautionary tale about the perils of earnings pressure and the dangerous intersection of charismatic leadership with unchecked authority. It reinforced the importance of whistleblower protections, leading Congress to strengthen the Sarbanes-Oxley Act's provisions for anonymous reporting and retaliation safeguards. Today, the legacy of the HealthSouth fraud lives on in boardrooms across the nation, where executives are reminded that the pursuit of profit must never eclipse ethical responsibility. Subscribe to The Verdict for more stories like this.